Hey, everybody, welcome to episode number 3 of the Raw and Real Estate Podcast. I'm Belladonna Rizzo. I am here with my most awesome co-host, Chay McGee, who is standing up in our second studio because he is bringing like the thunder today.
I was a little low energy last time sitting down. That's not going to work. So we'll stay standing like we do when we're calling and dialing to make money anyway. So
that's right. And get my longboards are on the back wall. So if you get really bored, you could just jump on a board, baby.
Yep.
All right. So as promised, we are continuing our seller finance series. And today, right, we're talking about benefits to the home buyer for doing seller finance as opposed to going out and getting a traditional mortgage. And so Chay, I know you and I, we actually really were talking through this and kind of deciding we're going to talk about our favorite top 10 benefits to the buyer today. And we really it was interesting that we had different benefits that we came up with.
Yeah, we came up with 2 very different lists, and some of them, of course, coincide, but there's a lot of benefits to the buyer for, seller financing and going about it that way. And it was fun to see your experience and my experience coming up with different things. None of them were wrong, but we actually had to kind of cut them down and kind of mesh some together to make it all work. But I guess it just means there's a whole lot to do with seller financing and just a ton to get into, but not to waste any time. We'll drop into that and kind of get up and running and show what you as a buyer can expect with seller financing and utilizing this to make it better than really what you can find with the banks and going traditional.
Yeah. And it was actually really exciting. We literally had to pare it down to 10. And so I'll go ahead and kick us off with number 1. You guys, I have my top 10 over here. And so I'm just going to glance over at them. And one of them, and this is actually probably hands down one of my favorite things about seller finance benefits to a buyer. And that is a buyer who may not otherwise be able to purchase a home and have that stability of having their own home, investing in their future wealth, just having a home of your own, right? Nobody can tell you what the hell you can paint your room or whatever. You've got a place that's yours, right? Buyers that would not otherwise get approved with a conventional loan can still buy a home and take advantage of all those benefits with seller financing. And just off the top of our heads, we came up with several kinds of buyers that this really benefits. One, being self-employed ourselves, self-employed people who just don't qualify because they either haven't been in business long enough or they took so many tax write-offs that they just can't qualify yet. So they just need time to start claiming that income.
And that's a really big one for, like you said, us being self-employed, but there are many others that are. Another one that I've used this with is truck drivers, because truck drivers, their companies can change how their pay structure is set up, and that can completely foul them up with the loans. But this helps take care of that. A lot of times with traditional financing, if you're doing a whole lot of overtime and stuff, they can't count it, or they have to, kind of take what you did during slow times, or if you've got off time or anything, and they've got to put all that together. Whereas this doesn't necessarily have to be that, and you can still get into a home and not have to be watching all your friends and stuff that aren't, let's be honest, hustling as hard as you are get into homes because of your pay structure and what you have to do to take it home.
Exactly. And a lot of people don't realize, right? If a big portion of your income comes from overtime or bonuses, you have to show proof of 2 years of consistently receiving that income. And then they take an average over the 2-year period. So you don't get credit for all the money that you actually earn, which can be a kick in the pants for people, right?
Yeah, and so, especially like truck drivers, like I kind of mentioned, sometimes in the winter, there's a real big dip or construction or things like that. Sometimes there's layoffs or furloughs and things like that, which will kill you on a mortgage. But here, that's not necessarily the case. You can still get into a house.
It's no big deal. And then, of course, we are now seeing in I'm California, okay, but we're starting to see more and more clients here in Utah who they are in the country legally, but they don't have citizenship yet. They don't have a social security number yet. And the only kind of loan they qualify for is called an ITIN, which is in the past historically been a very, very expensive loan to get. And you've got to jump through a tremendous number of hoops.
A
lot of paperwork. And let's face it, I mean, these folks are almost like a double whammy because often they don't have a social security number for an ITIN, and they're doing an ITIN loan, and they're self-employed.
Mm-hmm.
And so it's like double slam hard to get approved for a regular loan.
Yeah.
Whereas with seller financing, none of those things matter, right? None of it matters. And it allows people to buy into the dream of home ownership. And then, of course, the one that we're all familiar with, right? I mean, life comes with its fair share of hard freaking knocks. And if you're
especially over the last couple of years, everybody's been taking a beating to some level or another. And you've got, medical debt, or you've got these things, a lot of people
being furloughed from COVID, or God help you if you owned a small business during COVID and it struggled.
Right. And you're trying to climb out with your credit. You're doing the right things. You're following the plan, but it takes a long time, usually like 60, 90 days for the credit companies to start making changes. But this is something where that doesn't necessarily even play a part. It cannot even be looked at in some circumstances. You've got a good job. You've got a good income. You're doing your best. You can show that you can pay it, back, and you can, make the mortgage on that. There are times they don't even look at the credit. They don't even care.
Yeah.
You've got it. You're working hard. We're willing to give you the benefit of the doubt. We're not going to absolutely blast you on the interest rate. And it's pretty much it's a non-issue.
Yeah. You've got people that could literally walk out. Let's just say you just walked out of a medical bankruptcy. You could turn around the next day and go buy a home, right?
No, 1 year, 2 years outside of discharge, none of that.
Yeah. Right. Where normally it'd be years. You'd be years in rebuilding and trying to get to the point where you're trying to pay. So that, I think that's obvious.
I mean, that's something too. If you had a foreclosure because of that, and that can take 7 years to get off. And in this case, that doesn't necessarily have to be anything like that as well.
Nope. And so that was a huge one. So that was number one, that clients, buyers that would normally be barred from the benefits of home ownership can own a home. And that's kind of awesome. And then we've got, you want to take number two? Because this one's kind of cool.
Down payment alternatives. Now, normally, if you watched our last session, seller financing has a higher down payment. And that's almost always true, 10 to 20%. But it doesn't necessarily need to be cash on hand. There can be things where you got a boat, you got a thing of chickens. I'm just saying, it can happen. It can happen. You can spread that out as part of the payment if you can negotiate that and have that big down payment not be as hard up front, and pay that with your regular payment moving forward. And there's no way a bank's going to give you that kind of option.
No, you can even, I've even seen deals where they traded property. Somebody had a little cabin in Island Park, Idaho, and they're like, well, we don't have 100,000 down, but we'll give you the cabin. Yeah. I mean, talk about creative financing and flexibility. As long as it works for the buyer and it works for the seller, it's good.
Absolutely.
Yeah.
And like I said, the bank's not ever going to let you get away with that, but you can be truly creative with that. And then the next part of, we'll call it, did we put this as 2.1 or 3, was right along with that, your short closing times.
Oh, so nice.
Realistically, I mean, mortgages right now are on average between about 24 and 28 days, sometimes 35. It depends on what it is. with seller financing, if you've got to be in somewhere, we can work it out. There's no reason to believe we can't get that done in 10 days, sometimes 5, sometimes 3.
We
I
just
don't know if
had
you do
one
it
from
faster than
start
that,
to
but
finish
there's a
in 5
lot
days.
that you can get done in 10 days. And if you're up against it and you have to be somewhere, this is a great option, and you're not going to find that anywhere else.
Well, and funny, just super quick, funny story. We just closed a buyer, and it's been about 25, well, it's been about 20, 15 years right there since he's bought a home, right? Pre Frank Dodd, he bought a home. I we both thought he was going to have a nervous breakdown getting through the underwriting process. It was so intense, and they just kept asking him for more and more and more info. And he kept reaching out to me and saying, like, is this normal? Like, what is going on? I'm like, it's totally normal. And I was like, Chris, if you don't feel violated and feel like you need counseling, the underwriter didn't do their job.
I tell every one of my buyers, the last week before settlement, you're going to feel picked on. It's not just you. They don't hate you. They're trying to close out everything, but you're going to feel picked on, and you're going to have to run around trying to find something from 2020 at this point that you haven't looked at or have any idea where it is.
Yeah. They're like, why do you need my divorce decree? And I'm like, don't ask, just give it to them. Just submit.
Just hand it to them so we can get to the closing table. You want the keys, right? They're holding that. We just got to make it happen.
Yes. And so the process itself from start to finish is so far less invasive. Now, I know this isn't on our list, but I just wanted to touch on it briefly. So here's what we're not saying. We're not saying that the buyer does not have to provide financials and perhaps even a credit report and proof of the ability to repay. But I would say, here's how it can be done in a way that's safe for everybody. Safe for the buyer, safe for the realtors, if there are any realtors involved, safe for the seller. And that is, here's what I don't advise. I don't advise that the buyer just turns over their financials and their bank account statements with bank account numbers and social security numbers to a real estate agent that hands them to the seller, because are any of those people certified really and trained to safely handle that documentation? And the answer is no. They don't even have the 90% of the time, they don't even have the properly encrypted equipment to receive it safely, meaning a loan officer can't just run home loans on their home computer. Okay. They have company issued laptops that are encrypted 9 ways to Tuesday to make sure that information stays safe. And so the way that we recommend that you do this, right, is you bring a loan officer into the deal, and you have the loan officer do a financial evaluation of the buyer, and then they turn their evaluation over to the home seller. They collect all that information safely and securely, so nobody gets accidentally hacked or pirated or whatever. And then if the seller has any specific questions, they can have that conversation. And then everybody is protected and nobody is getting sued after the fact because we mishandled confidential information that damaged the buyer in some way.
Absolutely. And agents, if you're watching this, you don't want that documentation. Don't let people give that to you.
No,
you want to be helpful. You that's don't. Fantastic. Belladonna and I want to be helpful, but that's not helping them. It has to go to someone with the right way to handle all of that sensitive information. Don't even get involved in that. Put the right set of people in there.
Yep. And then now this is a great one, right? Because I think this is not always understood very well. And that is one of the numbers. So we're on number 3. I slipped a third one in there. So I guess we'll do like 10, 11. But the buyer, from the day that seller finance deal is executed, from that day forward, all the future equity of that property, as that property appreciates, hopefully over time, belongs to the buyer. They get the advantage of that now.
Right, as opposed to renting and giving it away. You don't own anything. You can't really do anything. You get that equity right up front, and you can start making that money. And in Utah, I mean, even still, take out those 2 crazy years where we're like 24 and 27% year over year, because unsustainable. We don't really want that. But just where Utah is normally, we're looking between 11 and 14% year
which
over
is still
year,
insane.
which is
Double digit
insane.
appreciation is nuts. I mean, just to put it in perspective, historically, 5% appreciation was considered completely normal and healthy. And then 8% was like, holy crap, and we're still seeing double digit numbers.
And let's say, even if it was 5, worst case scenario right there, that's 5% of the equity is 100% more than you'd get if you weren't in a home and still trying to deal with those credit issues or the I-10 loans or anything like that. You can start getting it day one, and that's huge because by the time you figured all that out, which could easily take 6 months to a year, you'd already have that year of equity under there, and certainly can't promise equity by any way, but over the last year, you'd probably be sitting at probably 40, 50 grand or more.
Yeah, even at historic low appreciation for Utah, like let's say they bought a home for 500,000 and it appreciated at a modest 5% per year. That's $25,000 a year in equity accrual on the home, which is kind of awesome.
Absolutely.
And so, okay, that takes us to number 4, which is interest rates and terms.
Interest rate, this is one of my very favorite parts of the seller financing outside of, like, of course, like we talked about being self-employed. This is my next favorite part. The interest rate and the terms. You don't necessarily have to have a 6.5% interest rate, a 7% interest rate, depending on where it is. You can have a 6%, a 5%. You could realistically have a 3%, depending on how you negotiate and what else you put in it. On top of that, it doesn't necessarily have to be a 30-year amortization either. You can spread it out to 35, 40, 50, 60. There's a lot you can do. So it's not just, all right, great, we looked at your credit, here's your interest rate, here's your 30 years, here's your truth in lending statement that says that you paid 250% on the price of the house. You can do a lot with that, and again, be creative and find a situation that meets you as the buyer's needs as well as the seller's needs to make sure everybody's happy, and work something out that you'd never find elsewhere, but could very much be a great deal for both. Not one side needs to get hosed on this. Both can work out and make out like bandits.
So here's an example from my weekend, do I have a bald spot? Can you see? I don't know, because I was ripping my fucking hair out this weekend. Trying to get
You guys should see Belladonna when she's not on camera.
Oh.
I've got a couple, and I'll see if I can share them. It's a sight to behold for sure.
Yeah. So I've got this family, first-time home buyers. We are trying so hard to get them into a home. And they're on Sunday, the interest rate was 7%. And their payment on only a modest $390,000 home was $2,900 and change. Okay.
Ouch.
Now it's amortized over 30 years, and there's that's like in stone. You're not allowed to change
loan,
it.
this is what you're going to pay for it. Take it or leave
That's
it.
it. Now on Monday, rates went to 7.24. And their monthly payment on the same home went from $2,900 to $3,250.
Ooh.
One day is, and now $3,250 is really uncomfortable. Really uncomfortable. I mean, it's like a whole car payment on top of your house payment extra, right? Now with a seller finance deal, let's just use the same scenario and say my hair was under my collar. It was driving me nuts. Okay. Let's just say you have a homeowner that says, hey, I need to make a profit on this too. And in order for me to make enough profit to make this worth my while, let's use the exact same scenario. I need a 7.24% interest rate. But if that monthly payment is too high for you, it's okay. Instead of amortizing over 30 years, let's amortize over 40 or 42 or wherever we need to put it on that sliding scale to get that payment to fall into your comfort zone. It's such a blessing, right? To have that flexibility. It makes me not want to use banks anymore.
Well, yeah. I mean, being able to look outside the box and not just being, okay, here you are as a FICO number. here you are as a length of time on the job. It takes all of that really sterile kind of feel to it where you're a number, you're a time on the job, you're this, you're that, you're a paycheck, to, okay, what can we work out to make sure that this works with you? We have options. We can customize it. If it's interest rate, we can work with that. We can work with time. If it's time, we can work with interest rate. If it's down payment, we can do things. There's no other way.
You can work with
I've
sales
ever
price,
seen
you know?
that, yes, and absolutely, in sales price a lot. There's no other way that I've seen other than seller financing, and of course, cash. But I mean, if you guys all have $500,000 on hand, that's super duper.
Yeah.
Not everybody does. But it just gives a ton of different options and makes it feel more personable and like you're just not a number.
Yeah, absolutely. Right. You step back into the world of being a human being again, which is nice. And then we've got number 5, which is huge. I think it's huge for so many people, even if it's a small thing, but it's your home. You can make improvements. You want to, like, maybe you don't like the kitchen. Great. Got it.
Yep.
Rehab it. Paint the walls whatever color you love, right? You can make whatever improvements to the property you want to make because you really are the homeowner, right? And then I would just say, be wise. If you're doing an improvement that requires a permit, just pull the permit. Trust me, you don't want to.
You'll wish you had when you called us to sell it, and it ends up being problematic. Just
I got a really ugly one. Midvale City, Midvale. Sold some folks a home, and it had plenty of room for a 2-car garage because it had a carport, 1-car carport. There were still acres of room, and they built a 2-car garage, but they didn't want the hassle of permits, so they didn't pull permits. And one of the neighbors called the city on him, and the city came out. The setback, it was less than 6 inches.
They made them tear the whole thing down, didn't they?
They made them tear the garage down.
Oh.
And then they wouldn't re-permit them for it because then the city was mad that they tried to get it without permits, if you know what I'm saying, that they're playing hardball with them. So a lot of cities are that way. Mm-hmm. So word of warning, just get your permits.
Okay? You might think your neighbors are really cool, and they are really cool until they're not. So yeah, word of the wise, get it up front, just cross your T's, dot your I's.
Yeah.
Like she was saying, paint it, carpet it, do the lawn, do landscaping, put landscaping rocks out there, tear walls out as long as they're not load bearing. You have all these options. It's your house. It's not like a rental and things. You don't have to ask permission. You can do it and make it truly yours.
Yes, which is awesome. And add value. Like you've got equity that you're just building over time by doing nothing, right? But then you really build equity when you start making smart improvements, right?
Sure. Even if you wanted to, get your landlord to let you finish the basement, you shouldn't anyway. You're giving him, tens of thousands of dollars in equity. This case, you do it, it's yours. You get to take that extra bathrooms, bedrooms, finished floor space. You're good.
That's it. Okay, so I'm going to say we switch number 6 for number 7 because number 6 kind of comes after. And number 7's, I think this preys on people's minds, which is, okay, as much as I might not qualify for a bank loan right now, I do trust that when I pay the bank and they get my money, nothing bad is going to happen. They're going to correctly track my payments and give me credit for that payment, and I will stay current and nothing bad will happen to my loan. But how does that work when a buyer is paying a seller?
And I can see where that fear comes in because it's just Joe Rando and you could just be paying him. He could run off and things like that.
Go to Vegas.
Right.
He might want a new motorcycle.
Nice. That's right. Getting a title company, a good title company involved can undo all of that because they're collecting the money. They're making sure that things are taken care of. They're making sure that the mortgage is truly set up so when you pay it, you're paying your ownership. You are on title on the loan. It can't just be taken out, kicked you out, relock the doors, tough for you. Thanks for the money, get out. They can make sure that all of that is in line. So your interests as a buyer, because you're doing your part to make that payment, they'll make sure that you are protected with your ownership, just like it was a mortgaged property through the bank, because the bank just can't switch the doors on you either. There's always the possibility, if you don't pay for it, to get foreclosed on, but you're not those people. If you were those people, you wouldn't be listening to this podcast, you'd be listening to somebody else's. We only talk to smart people. Only smart people can find our podcast. They're somewhere else. But this is a really good thing, because being on title is a big fear with seller financing, making sure that that's all taken care of. And that's done with one of 3, I think, different documents. And we won't get into that today because that's really deep diving. But it absolutely can be protected so that you don't have to have that fear or anxiety.
Right. And there's a couple of ways, right? So when payments are collected, they don't go. So here's the one thing you're never going to do. Okay. If you only take one thing away from this podcast, you will never, ever, ever pay the seller directly. Okay. You're going to pay something called an escrow company. Because here's the thing, on 99% of the seller finance deals out there, there's an underlying mortgage, meaning the homeowner rarely owns the home free and clear. They have a mortgage on the property. Okay. So it is extraordinarily important that that underlying mortgage is paid on time every month, like clockwork, so that the bank does not issue foreclosure on the home that you're making your payments on in good faith. And so the way we absolutely ensure that that happens is you're going to make your monthly payment to something called an escrow company. The escrow company is going to take that payment. They are going to pay the underlying mortgage company directly. That money never passes through the seller's hands. Then they take the remainder of the payment that's left over and they send that to the seller directly. Now, why is that such of a benefit to you? Well, other than the obvious one, right? That the loan is getting paid. Your loan is getting paid and it's being tracked every single month. You've got accounting to prove that it's done. Taxes are being tracked so that you can claim your tax deduction for the interest that you're paying. And you can get credit on. So when at some point, and we're going to get to this, you're going to refi out of seller financing into a traditional loan. Those on-time monthly payments that you're making that will refi, they will count towards your qualifications for the refi, especially on FHA. So you get all of these great benefits. Now, there's some really technical stuff, guys, that I know if you're just a regular homeowner, you're like, I don't even know what the hell you're talking about. But I'm going to go there for a second anyway, okay? Because there are 2 other ways you really need to be protected. So what if you seller finance a home and then the seller goes out and gets a second mortgage and leverages it to the F and hill? Okay, that's a problem for you, okay? So what we do is at the time that this deal closes, we're going to file 2 documents because there's 2 protections that you must have as a buyer if you're going to sell or finance a home. 1, you need to make sure that they can't keep pulling money out of the property because, hello, it's technically not their property anymore. And 2, we need to make sure that when you go to refi that property, the home seller is going to need to sign something called a warranty deed. That's how it's going to legally transfer to you ultimately when you go to get your permanent long-term financing through a bank. Well, here's how we do it. At the time that we execute the seller finance contract, we execute 2 additional documents and the title company just holds on to them. They just hold on to them like this, right? 1 is called a notice of interest. You as a buyer are going to have a notice of interest recorded at the county courthouse on that property. That means the seller's not going to be able to go out and pull out a home equity loan or put a second mortgage on the property, okay? The second thing that we're going to do is we're going to have the homeowner sign that warranty deed at the time that we execute seller finance, and title's just going to hang on to it. They're just going to chill. And then when it's time for you to refinance, that warranty deed's already signed. Because what happens if the seller just refuses to sign it with their big fat jerk?
Exactly. We get it all signed right up front to protect everybody's interest. Again, this isn't taking advantage of a buyer or a seller. This is something built that truly benefits both, but we want to make sure that both parties are truly protected and that this is a good thing for them, their finances, their ultimate goals. And these documents isn't taking advantage or holding one person. It's holding both people accountable, just like any other mortgage. This is the deal. This is what we agreed on. This is how we're going to move forward and execute this all the way through the term of the seller financing. And then when it's beneficial to you as the buyer to refinance with traditional financing, the title moves over, everything like that. It's paid off. It's done. It's yours. Everybody's happy. Everybody has, taken care of their original arrangement.
Right. And then I know I'm going to get really in the weeds. Okay. And guys, this is what I do. I never mean to, and then I always do it. I'm going to get way in the weeds. Okay. This is for buyers and this is for agents who may not realize. So what's the difference? Traditional seller financing, the title moves into the buyer's name. Title comes out of the seller's name. It goes into the buyer's name, but you can only do that on a conventional loan or on a cash deal, or not a cash deal, forgive me, where the home is paid off.
Right.
It is illegal maybe illegal is the wrong word. It is absolutely not allowed by the lender for FHA, USDA, or VA for title to come out of the seller's name. It's not allowed, and they will crush you if they find out, right? And none of us are here to perpetrate loan fraud in any way, shape, or means. So a lot of agents, a lot of homeowners, a lot of buyers think then it's impossible to seller finance those properties, and it's actually not only possible, it's 100% approved. I should say, okay, I'm not an attorney. I'm a real estate broker, but this is from our attorney who's done all the research directly with HUD. And there's another kind of seller finance called contract for deed. And that's where title stays in the seller's name and it doesn't transfer to the buyer until the time they actually refi the property. You still get 100 of the benefits. Every single benefit that we've outlined for you so far in this podcast, nothing changes. You get all those same benefits. The difference is it allows you to legally and nothing bad's going to happen to anybody, to seller finance an FHA, VA, or USDA property. That's kind of freaking awesome.
And like Bella said, all of this is 100% on board or above board. I don't get into shifty real estate. Bella doesn't get into shifty real estate. This is all 100% above board, all legal, all ethical, and you can do this with the protections for both. You do need to have the right team involved. We've talked about your escrow title company. We've talked about lenders. We've talked about agents,
attorneys to review all paperwork.
Those are the ones. You have to have the right team. If you have the right team, there's no reason for it to be scary. There's no reason to wonder about what's going on, what your team's doing. Is it all on, above board? If you have the right team, they will talk to you about it, let you know what this is, why it's okay, how it affects you, and take all of that fear, misconception, and anxiety out of this. But again, I have to take the moment to say it is imperative that you have the right team of ethical and knowledgeable people to get this done right. But when you do, it can be everything that you need it to be.
Oh, it's a game changer. And then the one that I kind of was like, hey, maybe it makes more time to talk about it now. And that is when it comes time to refinance this loan. So seller finance, the seller can offer financing for as long as they want. I mean, they can offer you 30 years of seller financing and you pay until the house is paid off. Or maybe they only want to do 3 years or 5 years or 7 years or 10 years.
Or maybe you as the buyer do.
Yes.
Whatever is clever, you can work it out.
And then at that time, and we call that a balloon payment, that's when the loan has to be paid off in full. Whenever that comes due, the buyer now must go refi this loan. But they're not getting a brand new loan. They're doing a refi.
Right.
And so say no mortgage insurance most of the time.
Yeah, no mortgage insurance, not all the time, but a lot of time a refi is of a lesser interest rate than a principal home purchase. Not always, not a lender, but there's a lot of reasons that it can make sense for the seller to ask for the refi on there, but there's just as many reasons for the buyer to want that as well. It can work out, and with it being seller finance, there's a whole lot of conversation that can be had to make sure that it's what it ultimately needs to be now and in the future.
Yeah. So much easier to qualify for a refi. And also you don't need another down payment. So you're just coming in, you get to use the home's current market value to qualify as well. And then you've got a much lower loan. So you've got a good spread between what you owe and what the home's worth. Yeah, great for everybody.
Right. And I think that leads into what our next one was just the customization of the contracts. And we kind of already jumped into this. We'll just kind of go over it a little bit. Your down payment, all of that, your term, your rate, everything. We won't go over all over it again, but with what we talked about on refis and everything, it all leans into the flexibility that there's no one thing that it has to be. Everything is negotiable. Everything is on the table to make it work.
Well, and you can, unlike with a bank, let's say something, now it's no guarantee, of course.
No,
but
both people have to agree.
But if maybe something changes in your situation, maybe you agreed to have a 5-year balloon. And at the 5-year mark, something completely unanticipated happens. Maybe you change jobs or your family situation has changed. Something's happened so that you can't quite get the refi loan right then at the 5-year mark. You can just renegotiate with the seller and ask for another couple of years.
Can I do another, let's say you're 1 year out of losing a job. You have to show 2 on the mortgage. Hey, is it okay if we take this from our 5 to have 1 more year? So I've got that 2-year period to show on, my income and employment. And realistically, if it's worked out for the last 4 or 5 years, chances are it's going to be, yeah, that's fine. I'll take interest on that. We'll be fine. Have another year. And again, bank's not going to do that, but you can negotiate. You have the power to talk to somebody one-on-one and say, hey, it's changed a little bit. It can also be modified. I mean, you can talk about, hey, this rate is kind of killing me, or, otherwise I got this great promotion. I'm doing much better. I can buy down more. Can we shorten that up so I can pay more down on that to you and work that out? Those are all different points of flexibility that you can take advantage of.
Yeah. Awesome. And then of course, this is one that people forget. You can sell the property. You can sell it, right? So let's say worst case scenario, you're got a balloon at 5 years, and let's say something happens, life happens, you're getting divorced, and neither of you can afford to keep the home by yourselves because the payment's just too high. And maybe it's a divorce situation anyway, so the equity needs to be split, whatever. It's not a situation where you're going to be able to, 1, refi, and 2, renegotiate with the seller because the whole situation of your life has changed. Maybe you get relocated out of state, whatever. Sell the property right then and there before that balloon comes due. All that equity is yours, baby.
And the seller's paid out, you're done. The equity is yours, just like having it with a bank. You still have that option at any time to get that done, sell, move on to your next, adventure. Gives a lot of leniency and options. Absolutely.
Yes. And I think we hit 9 and 10 in one shot, because we were saying all the equity that property has accrued over that time belongs to the buyer, as it should.
Absolutely. So, I mean, this was a really good list, and Belladonna, thank you so much for helping me go through this. Seller financing it doesn't have to be complicated. It is, but if you have the right team, it's not something scary. But again, I absolutely implore you to find the right team that knows how to do this and how to protect your interests with this. Feel free to contact Belladonna. Feel free to contact myself. We have a tremendous team and support when it comes to this. Neither of us pretend to know everything about seller financing. There are people that make
we have experts who do.
Yeah, we have experts that make us feel like we've talked about it for 10, 20 minutes because they've spent their entire careers, decades doing this. So if you have questions, let us know. We're never going to give you the quick answer. We'll find you the right answer and help structure that and make it, what you ultimately need it to be.
Okay, right on. And then we'll see if, what the demand is, but we could do seller financing for investors next week. And man, do investors love seller finance. It is their favorite.
Absolutely. Guys, reach out to us. Let us know what you want to see, what is going to help you. We don't want to sit here and tell you things that's not going to, help you and be materially beneficial. Let us know what we can help with. Let us know what you're afraid of. Let us know things that you don't understand. We put this podcast together solely to help educate and get rid of misconceptions and fear. Please help us to help you.
Right on. Oh, I'm excited. We got 3 in the can, and we're doing this the brave way, aren't we, Shay? I mean, we're just like live streaming. So
we do a little bit of prep. We do a little bit of prep, but we just put it out live. So
because it's raw and real estate podcast,
right.
Baby.
It's not all polished and fake. This is raw and real. That's how we do it.
That's it. All right. So hit us up below. Let us know if you have questions. We take requests. Let us know if there's other topics that you would like us to cover. And we will see you guys next Friday.
See you guys.